All right, welcome back to our series, The Architecting of Bitcoin Credit Markets. We're now moving on to chapter 4, where we're going to talk about, I'd say, some semi-advanced TradFi concepts, things like secondary markets and securitization. And we're going to see how these can, if at all, apply to a DeFi native stack that we've described so far. As a reminder, we talked a lot about Morpho V2 last chapter. This kind of described how we can move away from more simplistic variable interest rate only loans to now being able to do fixed interest rate and fixed maturity loans, or things like compliance and institutional level lending. Basically, it's an architecture that's very modular and allows us to do a whole different kind of slew of different types of loans. Okay. But if we compare things like Morpho or Aave or any other sort of DeFi borrowing and lending protocol, a lot of those are focused on what's called just the origination, right? That's the act of actually just like creating a loan, of matching, the lender and the borrower, and, giving the borrower the dollars. But in TradFi, origination is just like one component of the broader credit stack. Very often, once a loan is originated, lenders are kind of doing financial activities with that loan itself, right? They're packaging that together, maybe in a process called securitization. They're selling it into maybe something called a secondary market. Maybe they're using it as collateral and borrowing against it. Like these types of activities, this post-origination machinery is very powerful in allowing us to reuse and recycle capital to drive interest rates down, to give you longer maturities. Like it's kind of the behind the scenes engine that really allows these things to scale and become more efficient. So what we're going to do is kind of describe what that would look like in more of a DeFi native sense. First, we're going to recap Morpho V2, and then we'll kind of go into some of the machinery that I'm referring to here. So as a reminder, in Morpho V2, we have lenders right up here. Maybe they have dollars and they're going to choose where they want to put their funds into these things that we call vaults, right? And maybe you have a vault from A, B, C, etc. Vaults are permissionless, meaning anyone can essentially create a vault and market themselves and say, I'm competing for your deposits, put your dollars here because we're going to allocate those funds in the most profitable strategies or the safest strategies or some combination, etc. It's kind of like free banking, where you have all of these different entities that can say, send us your deposits, we're going to compete for those. Each vault can then allocate their funds however they want. Maybe they want to put it into variable interest rate loans. Maybe this entity wants to put it into fixed interest rate loans. Okay. And then you have the borrowers here. Maybe they say, I want fixed interest rate loans. And maybe this one says, I want variable interest rate loans. And maybe you can mix and match. And, they put some into variable, some into fixed, some into institutional lending. If you have more questions on this, check out our last episode. But this architecture here is very flexible. Okay. And these are called markets down here. Okay. And so the next part is, I kind of indicated this at the end of the last episode, but there has to be some way for the lenders to have a claim or like a receipt that, hey, I gave you $100. You're going to give me $100 plus the interest back, right? And like kind of like what's backing my money. Okay. And so in Morpho and really all DeFi protocols, these protocols spit out something called a receipt token. In Ethereum language, it may be called like an ERC4626 token, but it's basically kind of like an IOU, or I should say it's like a claim representing the IOUs. And then a fractional share of that is given to the lender, okay? So in this case, I'm saying that this Vault A is allocating maybe some to variable interest rate loans, some to fixed interest rate loans. They kind of create this stack of all of these IOUs of all of their loans. That's tokenized. And then the claim to those loans, the loan claim is given to the lenders. And that's kind of their receipt token, okay? And then so as you have different vaults, they also have their own receipt tokens, right? So I'm going to say IOUB here, and maybe this is like IOUC, okay? And so conceptually, this is actually similar to a concept in TradFi known as securitization, okay? Securitization is an idea of taking something or some things that earn some amount of cash flow and then packaging them together into something that is kind of like transferable or usable as collateral. And so you've heard of these types of concepts, right? If you've heard of things like mortgage-backed securities or collateralized debt obligations or collateralized loan obligations, right? If you're like a mortgage lender, You're lending dollars to people to buy houses. Those dollars are backed by the collateral of the house. You have all of these different loans. Maybe you're packaging together a subset of them. That's called securitization. And then now you have this like transferable asset, right? So these IOUs that are kind of just created by default, just because you need some way to tokenize these claims and give them to the lenders, like it's very similar conceptually to securitization, okay? And so I will kind of almost call these, this term, I don't know if it's been used before, but I'm going to call these like BTC LOs, right? Like these are essentially Bitcoin collateralized loan obligations, okay? And the reason this concept of securitization or CLOs or CDOs is very powerful is because the lenders who took their dollars and put them into these activities, they can take these receipts or these securities or these CLOs, whatever you want, and they can do things with them to better optimize their operations. So they can take these down here and they can maybe take this IOU and be like, look, I have this IOU and I want to recoup dollars from this, okay? So they say, I want to take dollars and maybe I want to sell these, or maybe I want to borrow against it. So maybe you have like $1 million of some sort of IOU claim. You want to sell that to recoup your money back for whatever reason. And you could take these dollars and these can go back to the LPs or the lenders to do whatever they want with it. Or you could say, I have this IOU, I have, $1 million of IOU A, which kind of represents all the loans that this vault had kind of allocated those funds into. And they say, I want to borrow against this. And maybe they, again, take those dollars and they receive them, and maybe they decide to loop them back into this strategy. So it kind of allows this circular flow right here, okay? This kind of basic example of, again, packaging up these kind of claims or these loans, again, whether it's DeFi, Bitcoin-backed loans or mortgages or auto loans, this idea of packaging them up, securitization, of being able to use those kind of objects for other financial activities, like to buy and sell them or to borrow against them, is like a secondary market. If you understand conceptually what's happening here, this is basically 90% of all financial engineering that happens on the planet. There's different names in different forms, but like this is kind of the structure that creates all of these different layers that make up like a credit system in its entirety, okay? So now that we've established this, let's think to ourselves, it's like, well, why hasn't this already formed in DeFi, right? DeFi has been around for like 5 or more years. Like protocols like Aave are pretty huge. And so the reason is because Aave and pool-based lending is very simplistic, right? You put in dollars, it's set it and forget it. You can only do variable interest rate loans, okay? So if you're somebody that puts dollars into a protocol like Aave, you receive a receipt token, the A token from Aave, and you're like, I want to sell this, like I have this IOU or this claim, I want to sell this. Well, the way pool-based lending like Aave works is there's always some amount of liquidity available in the protocol to either be loaned out or to be withdrawn. If that liquidity runs low, then the interest rates spike up, which refills the liquidity because people are like, I don't want to pay this high interest rate, so I'm going to pay back my loans. So there's really no need to create a secondary market to buy and sell these tokens, because you could just instantly kind of mint more of these tokens or redeem them from the pool. Like it's just designed where it doesn't need this whole setup. Similarly, maybe you say, well, I want to borrow against my A token. I put in dollars, $100. I'm earning 5% from the Aave protocol. Maybe I want to borrow against that asset and reloop that or something. It's like, well, what the hell is the point of that? You can lend it and earn 5%, but then you'd borrow it at probably around 5% as well. Like maybe you can make an argument that it's like safe collateral and you can get like a hair lower than that, but like probably not. So for an Aave style structure, this doesn't really make sense. But once you have something like Morpho V2, where you can do all these different types of loans, in particular, something like fixed interest rate or fixed maturity, a lot of this changes, right? So let's take an example and say that a user or a lender, an LP right here, has put into Vault B. Vault B is only putting into these fixed maturity loans. And let's say this is like 12 months, okay? And a lender says, hey, I put my money into Vault B. I now have IOU B or like some fractional share of it. and they say, I want my money back. They go to the vault B and they say, hey, can I get my money back? And it's like, dude, like, yeah, if we get some loans that are paid back to us, but we allocated this money into, long duration 12-month loans. Like we just don't have the money available on us, right? So now if you actually created a secondary market where you can buy and sell this IOU, you could have loaned originally into the 12-month thing, but you can sell early, right? That's the point of the secondary market, is you can sell this IOU early rather than having to wait for these lenders or for these borrowers to actually pay back their loans early. So it gives tons of flexibility there. Okay. The other thing to consider is when you have something like a fixed maturity loan, these are going to be higher interest rate because, the opportunity cost to lock up money for 12 months, lenders are typically going to say, I need to be paid, more for that. Okay. So if these fixed maturities are higher than the variable interest rate, which pretty much should always happen in a normal functioning economy, maybe variable interest rate again here is like 5%. Okay. So what somebody could do is they say, I'm going to put my money into Vault B. I have these IOUB tokens that are earning me 10% interest rate. I can post these as collateral and then I can actually borrow against it. And maybe I can borrow at a variable interest rate against these at say 5%. And then you can loop this back up and you could repeat that process. Now, this is leverage and this is looping and, buyer beware, so to speak. I'm not like advocating for this, but people want to leverage and they want to make more profitability. And so you could turn something that looks like 10% interest to, 20, 25, 30% just by doing like a few looping strategies. So it's a very, very powerful concept. And so this idea of, again, being able to do some sort of financial activity with these IOUs, with what I'm calling, BTCLOs, like this is what allows this whole system, the liquidity to really flow smoothly. It's what allows, us to take longer maturities or to have lower compressed interest rates, and which I'll explain here in a second. But okay, so let's assume that you kind of understand this flow here, and you're saying, well, like, who the heck is actually going to like buy and sell these IOUs, or who would actually lend dollars against these things as collateral? So we'll take this one step at a time. On the BTCLO side, this is actually, like, in theory, very pristine collateral. I would argue that it's like these IOUs up here, these BTCLOs, have the potential to be the single most pristine collateral in all of crypto, and maybe even like in theory in all of the world, right? We talk about Bitcoin as being pristine collateral, which it is because there's no counterparty risk there, but it's volatile, right? Like, because it's volatile, you have to have lower loan to values. You have to put up, 2 times as much collateral as, dollars that you borrowed. But these BTCLOs, like, these will be dollar denominated, right? So you could basically think of them as like stable coins backed by Bitcoin. People put in dollars. These dollars are backed by Bitcoin collateralized loans, but these IOUs themselves are actually like dollar denominated things. Like, if you put in $1, you get out $1 of IOU. That kind of earns like a yield of 10% over a year, and that makes it much safer collateral because there's less kind of volatility there, which means that you can do higher higher loan to values and attract more dollars who would be willing to like lend against this, right? In theory, I would actually expect the variable interest rate that gets charged against credible IOUs to be lower than the variable interest rate of Bitcoin. Okay. So the next thing to consider here is these are verifiable. Okay. So in DeFi, there's just like a lot of shenanigans where it's like you have these random assets and you can post those as collateral and borrow against them. And it's like, it represents some off-chain credit fund thingy. And it's just like, what the heck is going on here? But these Bitcoin CLOs, assuming they are only backed by Bitcoin, it's like you could take this IOUA and be like, oh, I can see on chain that 50% of IOUA is backed by variable interest rate Bitcoin backed loans. 50% of it is backed by fixed maturity loans. Maybe that's, some of these are kind of expiring next month, some of them in 3 months, and so on. And so you have perfect verifiability here backed by like very pristine collateral. And so this verifiability, we're going to come back to this, but this is like a huge, massive deal and benefit that we get on chain that you cannot replicate off chain in centralized systems. Okay. So the verifiability gives you like very, it makes it a lot safer for a lender that they can verify the kind of underlying. You don't have to trust the value, it can all be verified. Okay. The other thing is I would say it's very scalable. Okay. We know that there's huge amounts of demand to borrow against Bitcoin, to borrow against variable and to borrow it fixed, maybe from institutions to borrow it, right? Like very cliche, like we know there's trillions of dollars of Bitcoin collateral, right? So the more demand there is to borrow dollars against Bitcoin, the more that these kind of BTC-LOs will exist in size and scale, okay? And so this is why these BTC-LOs can essentially become, I think, the most pristine collateral to ever exist. They're dollar denominated, so you don't have the kind of volatility there. They're perfectly verifiable on chain, and they're hugely, massively scalable because they're a derivative of how much demand there is to borrow against Bitcoin. So BTC-LOs, very, very compelling assets that can now be created. Okay. The next thing we have to say, it's like, well, all right, so is this flywheel actually going to work? Like, who is going to participate in this? You know, why would lenders actually do this? Why would they put dollars in here and then take these IOUs, these BTC-LOs, and either sell them and buy them or borrow against them? Probably the main reason is it's very profitable, okay? This is the leverage loop that I talked about. You know, lend the dollars at a higher interest rate, borrow at a lower interest rate, loop the strategy. That's what banks do. If you've heard of the concept like borrow short, lend long, it's like borrow at a short term, basically like a variable interest rate, just like what's called overnight, lend it long term at a longer duration. By taking on the longer duration risk, you can charge a higher interest rate. And so you kind of collect this spread between what you borrow at versus what you lend at, you loop it. Classic banking strategy we're now enabling here in a purely Bitcoin native way. The second thing is liquidity. Okay. So let's say you're just a lender, you're just a normie, and you're like, I think I could probably lend for 12 months, but like I may need the money back after 3 months. So it's like, I don't want to lend into, you know, a vault that does 12-month loans. Okay. But, and so if you're not willing to lend at these longer durations, then the borrowers are punished because they want to borrow it at the longer durations. But if you know, you say, hey, like I have this secondary market that I can sell my IOU at early, then you'd be willing to lend maybe at 12 months. You say, hey, I'm willing to go into this Vault B, even though like a lot of these are originated at 12-month durations, because I know at any point in time, assuming everything is functioning safely, that I can just sell my IOU. You know, I can sell it, I can recoup my funds, I can get out early. So this ability to have like secondary markets to provide liquidity, huge deal. So lenders love this strategy. Very profitable, very liquid, works out great. Okay. So for borrowers, okay, it's like, why would the borrowers down here who have the Bitcoin collateral, like, why would they support this? Well, to be honest, they don't need to. Most of the time, they have no freaking idea that any of this stuff is actually going on. But it's hugely beneficial for them because it actually lowers interest rate. Okay. If you kind of provide this secondary channel for liquidity, right, it's going to lower interest because it's going to flow more dollars back into this protocol. If you're just saying, hey, there's $1 million here of lenders that are willing to lend into all these Bitcoin backed loans, that's kind of your ceiling. But if you can then, yeah, you create these collateral, you borrow dollars against it, you can loop these back in. That's going to just more supply of dollars, which means lower interest rates, right? And and the reason it's because like there's a huge, massive pool of lenders, of dollar lenders that's saying, look, I like Bitcoin backed loans, but like I don't want to lend my money for fixed maturity for a month, 6 months, 12 months. Like I need instant liquidity. So if you want the big boy dollars, like you have to kind of borrow from this pool and then pull it back into the Morpho V2 market. So again, this ability to open up this whole kind of financial plumbing layer massively lowers interest rates and maturity. Okay. And I kind of already described this this here. But when you know that you can kind of, easily sell out of these kind of, BTCLO positions, it allows you to take longer maturity. Lenders are saying, I'm more willing or more comfortable to take like a 12-month loan because I know that in the event of something scary that happens, I can back out of that position earlier. So this is the key part that we want right here. Like, we want the ability to do Bitcoin-backed loans, and we know most of the market says, give me the cheapest possible interest rate for the longest amount of time, and let's make it fixed. Like a lot of this is really just to get to that point. Okay. So I think that's pretty much the whole whiteboard. For me, this is like extremely exciting. Like DeFi is finally catching up. And like in last episode, we talked about how, okay, anything that can be done off chain with certain types of loans or custom parameters, we can now do it with something like Morpho V2. And now these kind of credit layers that all start to form and really allow us to reuse and recycle capital and that really make these systems efficient, like we can also do that on chain. And these concepts like securitization, which like off chain in a centralized manner are very costly and filled with friction. It's like, boom, it just happens instantly, automatically on chain. It's like these secondary markets, which if you're trying to run a lending operation, like a traditional TradFi operation, it's like bootstrapping like a market or finding, I don't know, someone like Ross Stevens or Stone Ridge to like, buy the loans. Like those are hard relationships to come by. If you want to borrow, it's like, how can you get low interest rates? Like DeFi has solved a lot of this. And so I just think this setup can very similar mirror TradFi, but actually do it better. Not like in a cope way where it's like, oh, hey, we're decentralizing all this stuff, but it actually sucks. It's like, no, like this is like legit and really efficient. And then the thing that's really like an ultimate game changer here is, again, this verifiability. Like all this kind of machinery, this kind of things that people don't often see, it's kind of like what Warren Buffett calls these like, financial weapons of mass destruction, right? It's like, they're like nuclear energy. They're so powerful for kind of creating credit markets and making these things efficient. But when you start adding all of these different layers and you start increasing this kind of like opacity, and you can't really see, you're like, okay, has this IOU already been pledged to this person? Like, are there 10 different people who all think they have a claim on one CLO, and then this person rehypothecates it to that person? Like, it's an impossible problem to solve off chain. But when all of this stuff is verifiable, from the underlying borrowers and the BTC collateral to who owns the IOUs to where it's being pledged and sold to, like that is a mechanism that will prevent these credit layers from getting like essentially opaque and exploding into these big, huge, massive credit events. So yeah, that's pretty much the whole presentation. Again, I think very exciting. This is kind of what our series has been building towards. And in the remaining chapters, I think really it's just going to kind of be more housekeeping stuff. It's going to be like, where do the trust and governance assumptions exist? Like basically, where does the multi-sigs exist in all of this? How do we talk about user experience and making this, feel like a, Venmo-like experience? And then we'll talk about some kind of end state, future facing things. But if you understand this, then I'd say that's most of the key whiteboard stuff that we wanted to articulate here. So again, as always, I hope you guys enjoyed this, and feel free to drop any questions.